3.85.
There it is. There it is. So a 25 basis point cut.
This was widely expected. The market had a 99% chance of this priced in.
They're saying still that maintaining low and stable inflation is their priority.
Well, as expected, the Reserve Bank of Australia has lowered interest rates. The question now is, how far and how fast will our central bank go? Hello and welcome to the Bloomberg Australia podcast. I'm Rebecca Jones. Through the post-COVID cost of living crisis, Australia's central bank took a gentler approach than its global peers to reining in inflation, managing to keep the economy close to full employment throughout. A rare feat that sparked debate about its viability as a model to tackle future crises. But now with inflation back in the target zone, the RBA on Tuesday reduced its key rate by 0.25 percentage point for a second time in the current easing cycle to 3.85%. Now, for those who have a mortgage that's on a variable rate, that is indeed good news. But what for the rest of us? Bloomberg's economist James McIntyre joins me today to try and answer this question. James, it's always great to have you here. Now, it's been a bit of a mixed economic bag of data in the lead up to this recent meeting. Can you talk us through the key things that would have been weighed up in the RBA boardroom this week?
Yeah, thanks, Beck. The RBA does a comprehensive sweep, as you'd expect any central bank does, of the data on the economy. But the key things would have been coming through, or the key things that at least markets and we've been talking about in the lead up, was how strong the labour market continues to be. It's surprising how resilient this jobs market is here in Australia. That and the CPI data, we thought it was stronger than expected. But when you look at it, actually, it was in line with what the RBA was projecting back in February. So they were, give themselves a tick there. And then the other piece of data that was out that was interesting was the wages data, and that was a little bit strong. Now, when we look at it, it actually was driven by, and the RBA pointed this out as well, it was driven by a couple of public sector wage agreements, but behind that, the private sector wages, the actual market side of the economy, the part that the RBA is actually influencing, that was continuing to ease off and go the way they wanted. So they weren't just looking at the headlines, they're looking behind it to see if they're getting the trends that they want to see in the economy. And it looks like, based on their decision, they got what they were after.
And is this what's ultimately led, James, to what some are calling a dovish cut, when the opposite, a hawkish cut, was what was expected? And I'll just pause there and explain for the non-bird watchers among us. In the context of financial policy, hawks and doves are terms used to describe different attitudes towards monetary policy. Hawks are the ones that generally favour a tighter monetary policy, often advocating for higher interest rates to control inflation and the like, whereas doves prefer looser monetary policy.
That's it. We had expected this to be a bit of a hawkish cut, and that's because we would have thought that the RBA would still be very cautious and mindful of the inflation side of its mandate. Inflation has come down, but when we look at how strong the labour market is, and that little bit of perkier wage growth than we might have been expecting, the RBA did dive into the reasons for it, as did we. But nonetheless, the general tone was one of, we think inflation, we're on the right side of it, but we want to just be very careful and measured as we go forward. That would be something where the RBA is still emphasising a focus on inflation. Whereas if you were to become a bit more dovish, which they ended up doing in this statement, we can really see that actually, in their commentary, the Reserve Bank said that the risks to inflation have become more balanced, and that they see that some of the upside risks that they had been worried about around inflation and also the economy being a little bit stronger than they might have expected have really pulled away and diminished thanks to the US global trade war. And so we've seen this shift I guess in a sense, from being hawkish and really worried about inflation to now starting to be a little bit more dovish and worried about growth and the labour market. Now, going in, the labour market figures hadn't said that, but when it's the commentary that we get from, say, the RBA's business liaison about business uncertainty, how their forecasts have shifted as they're thinking about the US tariff impacts, not so much on Australia because they're quite small, but more broadly on our major trading partners, they have taken that sort of pivot, I guess, to being a little bit more worried about growth. And that's where we would say that, okay, well, they're a bit more dovish, and that tells us that there's more cuts to come.
I want to pick up a little bit on something you just mentioned there. Now, Donald Trump's actions are causing uncertainty all over the world, and tariffs are something that Michelle Bullock mentioned at the press conference after the decision on Tuesday. James, based on her comments, how heavily did Trump's trade war weigh on this week's decision, or on balance, are domestic factors like Anthony Albanese's surprisingly big election win outweigh what's going on abroad?
Yeah, well, there's always a balance that goes into these things, and also it's the balance as it exists at any particular point in time. And so, if the RBA might have had their meeting immediately after or very soon after the election, but before the US and China struck a deal, and there was still a maximum degree of uncertainty around trade, and markets might have been suffering quite a bit, they might have gone the way that they might have opted for the decision that they talked about with a 50 basis point cut. So it does matter. But what Bullock did tell us is that the economy domestically on its own was enough for a cut. The Trump and tariff situation was potentially enough that it could have gotten them over the line to a larger cut. But thanks to the truce and thanks to a little bit of the confidence re-emerging on markets at least, that we might not see some of the more extreme outcomes on the trade at the moment. We've got to wait till the end of those 90 days to find out really what's what.
And it is very much a game of what's known and what's not known, right? Because we do know the dates of these RBA announcements. That's locked in. That's a certainty. We did know the date of the federal election that we've just had, but other things are less easy to control, shall we say. James, let's take a quick listen now to Governor Michelle Bullock. She had some interesting comments at the press conference on Tuesday around consumers. Let's have a quick listen.
We actually have rate cuts incorporated into our forecasts. So what we have in our forecast is a pickup in consumption, and that's a product of the fact that real household disposable incomes are rising, and that reflects not only the fact that wages are now rising and inflation is much lower, but also the fact that interest rates are falling. So yes, we would expect consumption to be picking up. It's picking up a little bit slower than we thought. Households are being a little bit cautious.
So, James, those comments are a bit different to what she was saying after the April rates decision, right? Especially around the consumer sentiment, as we heard there. What do you make of this?
My view on this is, and if I look back not just to April, but even before to February, and even as we go back to the end of the year, when we think about how the RBA has been thinking about the economy, 2025 is a year where growth is picking up after a very lacklustre 2024, but one of the key drivers of that pickup has been a recovery in consumer spending. And so, but what we've seen though is that we've got the first quarter of data through retail sales, retail trade, and then household spending, and it's not looking all that as strong as we might have thought. Now, it's too early for the February rate cut to really have had a big impact. But we're seeing a few things there where the RBA has been dialing back their consumer spending forecasts. Now, a little bit less population growth than they'd had 3 months ago, fine, but that spending isn't there in the economy. Confidence has been hit by the trade and tariff uncertainty, and that's one of the channels that this can flow through. So if we're not, if the RBA is a little bit worried about consumers not opening in their wallets as much as they might have hoped, then that tells you that that there's a little bit less or shakier confidence in the economic outlook for the RBA, and that's something that will probably lead them to be a little bit more responsive on rates.
So as of now, the market is pricing in 3 rate cuts by the end of this year. James, what impact would you expect that to have on the country's housing crisis? Are prices just going to keep going up and up?
Well, 3 rate cuts on top of the 2 that we've already had. If markets are right and that's where the RBA ends the year, then that would be 1.25 percentage points, a full, quite a large amount of cuts.
So yes,
over the course of a short period of time, and that's going to feed into what people can borrow. And yes, that means that people will go out there with more buying power, the same amount of homes. We are boosting supply, but not fast enough. More buying power, same amount of homes. It's a fairly simple equation that prices will continue to rise, and it will get worse. And what we will see is that those markets where it's been quite challenging for affordability, Sydney and Melbourne, where buyers had been kind of capped out, and price growth hadn't been as strong. They might be ones that benefit early on, as people can afford to borrow more and buy with larger tickets. But eventually we will continue to see that spill over into the other more affordable capitals like Perth, Adelaide, Brisbane, and we will see the strong growth that's continued there, perhaps getting a little bit of a tailwind as the RBA continues to deliver those cuts. It's just an unfortunate reality of trying to support the whole economy, that as we reduce the cost of borrowing, that means that people can borrow more and they will go and bid those things up. But that's the trade-off we have for trying to make sure that consumer spending stays strong, business investment picks up, and we buffer the overall economy from some of the shocks coming from offshore.
And Michelle Bullock's often said that she has, and the RBA has just one instrument. You are saying there, James, though, that Gen Z and, millennials, older people who haven't been able to get into the property market here in Australia are going to find it even harder as the cuts come in, if they don't time it correctly. Let's take us now to a quick break, and when we come back, we'll whip out the crystal ball with my guest, Bloomberg's economist James McIntyre, to see what the next 6 months has in store. You're listening to the Bloomberg Australia podcast. And welcome back to the Bloomberg Australia podcast. You're here with me, Rebecca Jones, and I'm with Bloomberg Economics' James McIntyre. We're conducting an autopsy of sorts on the latest decision from the RBA to cut interest rates. Nobody pores over every word spoken by the Governor, Michelle Bullock, than you, James. So tell me, when the board meets next, which is going to be in July, what are they going to be looking for between now and then that's going to help them make their decision?
Well, the key ones are going to be the labour market and inflation. We've got some GDP data coming out as well, but we pretty much know from a lot of the real-time tracking around how things are going, especially around the consumer, which is a key focal point for the RBA. But it's really going to be about, is that labour market still holding up strong? Or how much slack is emerging in the labour market, and what's going on with inflation. We'll only have one of the monthly indicators for May, so we won't have the full quarterly suite. We'll have to wait for the August meeting for that. But those are the key domestic things. Now, when it comes, however, confidence could be hit and buffeted, either confidence in terms of the share market and any wealth effects or impacts from that, or business and consumer confidence could be derailed by whatever we see coming from offshore. So it's not just the domestic story that the RBA is going to be worried about. If we think about the China-US truce being something that kept a 50 basis point cut off the table, if there's an eruption, if there's that truce crumbles, and that there is an eruption of concern around trade, or maybe it might be the bond markets melting down over the US fiscal position over the next couple of weeks. That could be something that could tip the RBA over into delivering a further cut in July. Our forecast had been for the year that the RBA would be delivering only another 2 this year. Markets are there at 3, and that those 2 rate cuts would be delivered gradually and slowly and dribbled out over time in August and November. But if there is this shock, if there is more uncertainty, and that uncertainty corrodes business and consumer confidence, then we'd expect that the RBA might be prepared to step up and deliver another cut in July.
So to recap, it was nice of the RBA this month to show it's willing to cut and to reveal a bit more about their thought process. These decisions aren't mutually exclusive. The RBA doesn't exist in a bubble outside of the forces that are occurring in geopolitics and other economies around the world. We still don't know how fast or how far they're going to go in terms of rate cuts, but the language to your view, James, is that the RBA is poised and alert to these happenings, and if things do take a nasty turn, they're going to be right there in the game, trying to minimise the damage. Let's try not to end on a downer, which often happens when we're talking together about the economy. I understand this. James, looking at your crystal ball, what are you predicting is going to happen at this next meeting in July? Cut or hold?
Well, yeah, the crystal ball or the optimistic view is that we don't have these big disruptions and that things continue to tick over in the economy, and that means the RBA can hold and deliver that next rate cut when they do their full assessment in August. So the positive view on the economy is that growth continues to tick along. The labour market remains fairly well resilient. We've still got a 4.1% unemployment rate. It's incredible. And that continues to move along. We get some improvement in residential housing supply. Yes, you will get a little bit of a pickup in house prices, but that the RBA is able to kind of look through and go, well, we are still restrictive. We do need to let the leash off the economy, to take our foot off the brakes. And doing that is a slow, gradual process. So hold in July with cut in August. That's our base case. But if they do look at things, and if they're seeing a pretty ugly picture outside the rearview mirror that unfortunately they have to look through, then we could see them step on that accelerator to try and give us the best chance of weathering whatever storms the global economy throws our way.
James McIntyre, thank you for joining me today.
Thanks, Beck.
And thank you for listening to the Bloomberg Australia podcast. I'm Rebecca Jones. This episode was recorded on the traditional lands of the Wurundjeri and Gadigal people. It was produced by Paul Allen and edited by Ainsley Chandler and Chris Burke. Don't forget to follow and review the show wherever you get your podcasts and sign up for Bloomberg's free daily newsletter, Australia Briefing. Go to bloomberg.com to subscribe.